Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the show. We have a massive episode for you today. My name is Bryce. As always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Very excited as we kick off 2025. And we kick off the year, as we always do, with our bold predictions. On Monday, you and I spoke about how we thought the year would unfold.
Yeah.
And today we have Andrew Brown joining us in the studio to share some of how he thinks the year will unfold. Andrew, welcome.
Thank you very much. This is the sixth time I've done this. So,
now, it's interesting you say that because before we get into it, I need to wish Bryce a happy anniversary.
Yes.
Because Wednesday, the 22nd of January, was our 8-year anniversary from the first time we ever published Equity Mates Investing. So happy anniversary, Bryce.
Thank you, Ren. Thank you. And Andrew, I think you would have been episode number 3.
I think I was episode 3. I was your first outside guest.
First guest. I remember recording that in your office near King's Cross.
That's correct.
We had one microphone between us. We're all sitting a long way away from the microphone.
The best lesson on value investing, I think.
Oh, it was pretty good. It was supposed to go 40 minutes. It went for an hour.
It was a
and 40.
two-parter.
We had to split it in half.
No, it's good fun. It's good fun.
Yes.
Congratulations, guys. Really,
Thank you.
brilliant.
Now, 8 years in, and we're still building, and we want your help to figure out what we should do next. We have the annual Equity Mates community survey live in the field now. The link will be in the show notes. It'll be on Instagram. It'll be wherever you follow Equity Mates. It really helps us figure out what we're going to do next, to hear from you what your investing challenges are, what you want from Bryce and I, what you don't want from us. Last year, it pushed us to send our email to daily and to focus on news. It's led to a couple of other shows that we've got cooking in the works. It led us to focus more on YouTube. So it really does make a difference. So please fill it out. It really does help us.
Yes. And if you complete it in full, you'll go in the running to win $500 cold hard cash.
That you should invest. But Andrew, that is all the housekeeping done now.
Brilliant.
Every year, you bring us a number of bold predictions. We actually haven't seen any of the predictions this year, so we're excited to get our raw, unfiltered reactions.
Yeah.
But where do you want to start?
Well, what I want to start is it is the 21st of January. Okay, the S&P 500 futures, because the market was closed overnight, are about sort of 60-30. At the end of 2024, they were 58.81, so they're about 2% ahead of where they were there. NASDAQ similarly is about 2% ahead of where it was at the year end. The Aussie market is 2.5%. The 10-year bond rate in the US is 4.57, and the Aussie bond rate, hint, is 4.5. Okay, so that's the kind of mechanics we're looking at.
That's where we're
right
at.
now.
Yeah.
Okay. A disclaimer from Jason Zweig on the Wall Street Journal, 10th of January, headlined, "How can you see through Wall Street's wall of wrong?" And he basically says the 1-year point estimates of equities by analysts, that's building bottom up, have minimal correlation with the outcome. And by market strategists, that's top down, they have absolutely zero correlation with the outcome, just to prove that financial strategists are absolutely the most useless people in financial markets. Don't listen to them.
With that
On that note, there is a theme behind what I'm going to talk about today, and the theme is the unraveling of stupid.
Okay.
All right.
Okay.
Nice.
So, prediction number 1 is that US equities will finish 2025 at least below 5,900 on the S&P. So we said it's about 60.28, and most likely will finish in a band between 5,500 and 5,800. Why? The first unravelling of stupid is we got a return of 25% on the S&P 500 last year, of which 54% came from the Magnificent Seven. Why is that stupid? It's because the earnings per share for 2024 actually will finish the year estimated at lower than it started, and 10-year bond yields went from 3.85 to 4.79. So the two things that drive equity valuations all went the wrong way, and yet the market went up 25%. I acknowledge that analysts look out beyond the current year, but I note that the 2025 estimates for the S&P 500 at 273 did not move during the year. We have finished the year with heavy euphoria. The 2025 year has started with even more euphoria. Now, think about Melania coin and Trump coin and the other coin. I think we're getting pretty close to maximum euphoria. I would also point out to you that based on data from 1970 to 2024, the S&P 500 is something like 5 standard deviations in return terms ahead of the rest of the world. So the Morgan Stanley Capital International, or MSCI, ex-US. So the US is so far ahead of the rest of the world in terms of return.
So that's your first prediction. Just to put percentages to that, the 5,500 level would be about, what, a 9% fall?
Yeah, about 9 to 10% fall. Yeah.
Okay.
So I'm not looking, it may go beyond that at some stage, and don't be surprised if it does, but I'm not looking for a catastrophe. You'll see sort of why as we go along. But I should point out to you that of 20 Bloomberg strategists Bloomberg interviewed, not one of them has the market going down.
Really?
Not one. Okay. So that tells you everything. Prediction number 2 is one of the reasons I think driving that is I think the AI use case is going to be questioned this year.
Okay.
At the level of investment which is taking place. To give you an idea, in 2023, the 4 major AI investors, okay, that is Meta, it is Amazon, it is Alphabet, and it is Microsoft. The 4 of them in 2023 spent $147 billion on AI-related stuff. In 2024, they spent $209 billion. And in 2025, they are programmed to spend $244 billion. 80 of that alone is Microsoft. Okay. Now, please remember, these companies earn, with the exception of Amazon, they earn mid-30s return on equity. None of them carry debt, or none of them carry net debt. So basically everything they're putting into this is ostensibly equity. And so what I'm saying is you would need to see over a period of time, could they get a 30%-ish return from the investment they're making in AI? I'm not going to say no, they can't, because we don't really know where this is going to get to. But what I am saying to you is I think that is going to be challenged this year, simply because the ramp up is so major. And to be quite blunt, by and large, the ordinary person, and indeed the ordinary corporation, and indeed these corporations, bluntly, are not seeing any kind of return from AI at the moment. They're not really seeing any major return on AI other than, drawing cartoons that you don't really need. Okay. I can tell you, I try to use AI as much as I can to sort out data. It's not very good. It's really not that great yet. It will get there. I know it will get there. Okay. And I'm not trying to, lampoon it, but I'm just saying I think the use case is going to be questioned.
Okay.
Nice.
So that's prediction number 2. Prediction number 3, I think someone else around the table shares this prediction, which is that US bond yields will go through 5% at some stage. They may go well through 5%. Why? Number 1, we have an uncontrolled deficit. Okay. The deficit is $35 trillion gross. Okay. It's about 26 trillion net. The interest bill on that, we now know, is over $1 trillion a year. It's about $1.1 trillion a year.
Wild.
It is wild, okay? And the reason it's wild is that alone, the $2 trillion annual deficits that we're kind of running, they're 7% of GDP now.
The interest payments on the US government debt as like the fourth highest line item on their
that
budget
is
now.
absolutely spot on.
Yeah.
That's something you can't go away. You can maybe cut spending on other things. You can't cut spending on that. My figuring is the deficit is not controlled. It is highly unlikely the policies of President 47 are going to bring the deficit down. If anything, they'll ramp it up despite the DOGE. It brings into perspective credit risk. How can I sit around a table and say the world's safest instrument, a US 10-year bond, has credit risk? Well, people are going to start building in some kind of premium for credit risk, however you want to define that. Because we know President 47 is a spender, he's not a saver, that, the deficit is highly likely to just continue growing. So I believe that, investors in 10-year bonds are going to, get a little bit frightened from time to time, or we'll certainly go through 5 at some stage. And if we do that, that's not a good backdrop for equities at all.
Well, let me tell you, the US Treasury Secretary nominee, he said that the single most important economic issue of the day is extending the Trump-era tax cuts, not addressing the fiscal deficit in the US. So I think you're bang on there.
Spot on. Number 4 prediction, which will surprise you in the context of what I've just said, okay, because this is unusual in this type of environment. I believe the Russell 2000 will outperform the Standard & Poor's 500.
Okay.
So small caps will beat big caps, if you will. Why? Why do I say that? The Russell 2000's performance in 2024 versus the S&P 500 was its worst since 1998. And we all know why. So what's interesting is when the Russell turns, and if you think about what President 47 is trying to do, there should be some benefit of that actually permeate down through to smaller companies. One of the things that we struggled with in the last 12 months even, let alone the 4 years of the previous president, was that the regulator was really harsh on mergers and acquisitions. And I think that's certainly going to loosen up quite dramatically. And so my feeling is that there'll be more M&A. It's more likely to be down into some of the middle and smaller companies. They're much cheaper. And I think that if the economy mulls along, notwithstanding issues with bond rates that we've spoken about, the Russell 2000 can do quite well. I should add, when the Russell 2000 turns against the S&P 500, it turns big time. Okay? The last time it turned, you had 8 successive years of outperformance.
Oh, wow.
Yeah. Okay. Now, in 7 of the past 8 years, it's been well below the S&P 500. So, we must be getting close to a turning point. Yes, he said catching falling knife. But, it's been so acute, the underperformance.
Nice. Okay.
Prediction number 5. This is very US-centric at the moment.
That's
it's going to change as we go on. I'll show you. Okay. Prediction number 5 is I believe that highly priced, great companies are going to struggle. What do I mean by highly priced great companies? I've seen so many reports for 2024. Oh, we were fantastic. We did 35% return. It's fantastic. We had a big overweighting in First Isaac Corporation. Oh, that's great. It was up 55% last year. It's now 64 times earnings. Oh, we had a big overweighting to Walmart. It was up 71% last year. It's on 35 times forward earnings. We had a big weighting to Costco. It was up 38% last year. It's on 51 times earnings. No one is criticising these businesses in any shape or form. They are brilliant businesses, okay? But these brilliant businesses, in my opinion, have now got to the stage where the pricing of them is really crazy and it's out of whack. It's kind of a sort of late 60s kind of nifty 50 type of idea. And I've just picked three. You can, roam around and find many others. By the way, I should add that there are some counteracts to that. You can buy PepsiCo on 17 times earnings.
Oh, wow.
Yeah, with all its brands, Lay's as well as obviously the drinks. So it's not every company. It's been highly selective that investors have rushed into what they would perceive as the best of the best of the best. And I think some of that is going to start unravelling. The way it unravels, of course, is that, with bond yields moving up, people will question those multiples a bit. It's not that the companies themselves are, likely to make major mistakes.
Costco, Walmart, and Fair Isaac Corporation.
They're three I've just picked at not random.
Yeah. We'll use those to measure the prediction.
You can use those to measure the prediction. That's fine.
All right, number 6. We're ripping through these.
Yeah. Prediction number 6 is I want to show you what the potential mayhem from President 47 is going to be, and I'm going to use a Danish stock to do it.
Okay.
Great.
Okay. All right.
Given I only know one Danish stock,
Yes,
I think
you do.
I can guess
and
which
I
one
think
it
you
is.
can guess which one. Disclosure, I am long this Danish stock.
So am I.
Very
Novo
recently.
Nordisk.
Very recently long.
Okay.
The Danish stock is, of course, Novo Nordisk. Okay. Why do I want to use it as an example of the type of mayhem that might happen? Let's assume President 47 wants Greenland, okay? And in his quest to get Greenland, he decides to invoke some sort of tariffs or sanctions on Denmark.
Yeah.
What is the best way you could do that? You sanction or tariff Denmark's largest corporation. Because, of course, there is a competitor company which is American called Eli Lilly. It is a lot less further progressed in both obesity drugs and diabetes drugs. Okay, so Wegovy and Ozempic obviously being the two for Novo Nordisk. Would President 47 risk the ire of the world's most obese country, particularly amongst his voters, by putting tariffs on Ozempic and Wegovy?
Yeah, I mean, it depends.
I don't know.
Depends how much Mounjaro from Eli Lilly they can get their hands on.
Exactly, absolutely. Now, if you're a global investor, do you buy Novo Nordisk? It is an amazing company, not just because of these drugs, but the other component parts of its portfolio. The stock is now on about a mid-20s PE. Okay, Lilly's on sort of, depending on what numbers you use, about high 60s. So if you're an investor, do you actually say, hey, I just don't trust President 47 because he's anarchic, he's transactional, he does weird things in the middle of the night when I'm asleep. And would he do that? I don't know. If he did, the shares ain't going up, that's for sure. You could end up with Novo Nordisk on a P of 15, whereas at 25-ish, in my humble opinion, and I'm long to prove it, I think it looks fantastic. I can't believe you can buy it at these kind of levels. It's back to PE levels of 8-9 years ago when they didn't have these drugs.
Yeah.
Whether they're doing quite what everyone wants or not. Okay, so that's an example of the kind of anarchy that you may get, and the way in which you need to think outside the square when you're investing. And so if you like a Novo Nordisk, you probably wouldn't make it your biggest position just in case. Okay.
So what was the prediction there?
So the prediction there is actually that Novo Nordisk will do really well.
Okay.
Okay, but it's got that caveat to it.
Nice.
Okay? And it's an illustration of why I have a caveat on it, but I'm quite clearly, I think it'll do well from here and I'm long.
Nice.
Okay.
Okay, so we are 6 predictions
Six
down.
predictions in. Just to show you, by the way, on day one, just part of prediction 6, on day one, there were no tariffs announced, which was obviously different to a few weeks ago where we were going to have loads of tariffs on day one and everything else. And the way you find out there were no tariffs on day one is you read the Wall Street Journal. And the people in the administration were telling you to look at the Wall Street Journal.
Okay.
Because somebody gave an interview to the Wall Street Journal. This is the way things will work for the next 4 years. It's leaks. It's rubbish in the middle of the night. It's what are colloquially known as brain farts. It's just things that are off the top of the head. It's quite anarchic. So just, beware.
Alrighty, number 7.
Number 7 is stay long volatility stocks. Okay, now what do I mean by volatility stocks? My newsletter for the Dynasty Trust in December, we ran a little bit of a feature on these. These are companies like Virtue Financial, which is a market maker. They're companies like Compagnie Financière Tradition, which is based in Switzerland, which is it's the third largest inter-dealer broker in the world. They're guys that sort of make markets in the OTC. TP Intercap in London are the second largest, and Cantor Fitzgerald, now called BGC Group, are the largest. These guys benefit from volatility. They benefit from transaction volumes. Also, Flow Traders in Holland, they benefit from spreads, volatility and transaction volumes. Most of these companies did really, really well last year. Virtue was up 80%. Flow Traders was only up 20 and a bit, but from its low point, it was up about 60. So I would suggest to you that if you happen to be invested in these kind of companies, even though they've gone up a long way, most of them are still on P's of about 12. Some are below that. The interbroker dealers are actually on P's of about 9.
Why are they so cheap?
People believe they're really, really risky.
Okay.
There is some risk because they obviously operate as principals, but people think they're really, really risky. I think if you're long, and I'm long, and I made it very clear, I'm staying long because I think I'm going to get another year of reward out of these things. And so you might find that anyone else that benefits from being long volatility, so there might be some arcane company that you have that I haven't mentioned, stay there, even though you probably did really, really well last year. These companies predominantly benefit from volume and they predominantly benefit from spread, so bid-offer spreads. If you do your homework, you'll realise what happened to bid-offer spreads in the final quarter of last year. They blew out, particularly in November and December. You can find that information, if you dredge around NASDAQ websites and things like that, and SIFMA.
What was there a reason why that happened?
Yeah, rampant enthusiasm.
Oh, okay. So it's just
It was a function of rampant enthusiasm that we have to get set. Obviously, if it was November, December, obviously it was prompted by November 6th, and people just went bananas. It's another reason why prediction number 1 is prediction number 1. I can't emphasize enough to you all. This is a crazy environment we're in at the moment. It's positively euphoric. And euphoric environments like this, just don't hang around for too long. They can hang around for a while and it can get, I can be wrong and the market can go up another 10 or 15%. But eventually it will come back.
It's funny, it just doesn't have the same feeling of euphoria that 2021 did. Like the 2021 euphoria was like any stupid idea got funded, NFTs became a thing, everything was shooting up, good stocks, bad stocks. And I get what you're saying, that it's like there's euphoria here, but it doesn't feel like it's that that frenzied level.
It's a 1960s type euphoria. It's not we've had this debate on here before about about 1999. It's not one of those. I'm sure there's of course there's a lot of junk that's there, but it's not as pervasive as it was. This is big companies trading at big multiples. Okay, and people not really questioning. And so it's kind of set and forget. You can't go wrong. Well, yes, you can. Plus overlaid with crypto. And, clearly overlaid. And the reason big companies, because, they've bought their way to President 47's back pocket. They're the puppeteers. He's the puppet. They're the puppeteers.
Well, on that note, let's take a quick break here. We're halfway through, 7 down, 7 to go, I believe. So we'll be back with Andrew Brown after this. Welcome back to Equity Mates Investing. We are kicking off the year with bold predictions. On our last episode, Bryce and I covered off some of our predictions for the year ahead. And now, as we do every year, Andrew Brown from East 72 Dynasty Trust is here to talk to us about how he sees the year playing out. Andrew, 7 down, 7 to go. What is prediction number 8?
Well, prediction number 8 involves me getting on my 24-year-old Qantas jet from the United States back to Australia if it's not delayed or broken down or whatever. Okay, so prediction number 8 is I think we will have Australian election chaos in 2025, and that will actually be meaningful. What do I mean by chaos? I don't believe that either party will get a sustainable majority. I think there'll be a hung parliament, because I believe there will be more independence in Parliament, as it's likely the Liberal Party will gain ground on where it is at the moment, but it has a long way to go. 22 seats is quite a bit to actually overturn. I'm not saying it's impossible, because the electorate is far more volatile than it used to be. So 20 seats can seem, get overturned perhaps more easily than, they would have done 20, 30, 40 years ago. But I do believe the independents will hold the balance of power in the lower house. They certainly already do in the upper house. I don't see that changing. And so I think that's going to bring quite a lot of chaos to what's going on in the Australian Parliament. And that means it's going to be chaos in terms of economic policy. And that is rather meaningful given the fact that the economy at the moment is completely and utterly unbalanced. We've had one of the sharpest declines in real GDP per capita since the 1991 recession. And I lived through the 1991 recession, paying my 17% interest rate on my mortgage. We won't get to that. But, that was wicked. That was really difficult. Okay. And people's pocket, even though they're employed, feels like it did then.
Yeah.
Okay. And that's a problem.
Yeah.
Okay? That's a problem, because it's a problem for retailers, and that permeates across the economy. Yeah, there's a lot of structural change going on. I mean, there was a great article in a recent newspaper, news.com. I live in Coogee, and Randwick's main high street, which is called Belmore Road, it has 22 empty shops on it.
Wow.
And Randwick has $6 million houses.
Yeah.
Okay. So that's structural change, because they're obviously strip shops. They're not. And there's a couple of malls there, small malls. But things are changing at a rate of knots that I think bluntly the population's struggling to cope with, and they're not really getting a lot of help from either political party at this particular stage. So I think things are going to be a bit chaotic, and that is going to spill into
here we go.
Prediction number 9. Australian bond rates on a 10-year bond of 4.5 at the moment. I think they will categorically go through 5% and above over the course of this year. Why? Number 1. Risk premium. Why would you buy, if you're a foreign investor, why would you buy a 10-year bond in the economy around the world that's had the biggest decline in per capita GDP? Is number 1. Number 2, we'll follow US rates. If they're going to go above 5, we'll go above 5. Number 3, more deficit funding. Remember, the iron ore price is quite strong at the moment, but that's fairly temporary, I think, in most people's eyes. Westpac are probably the most aggressive at saying it'll fall 30% because of incoming supply. But it's quite clear that, it's a spend-a-thon now. And, I think that, the deficit's going to come back into focus once again. Fourthly, I think short-term rates, the next move in short-term rates may not be down.
Wow.
Might even be up. Why? I think the Australian dollar is going to come under real pressure. And I think there might be a situation where the RBA decides they might need to just change the rhetoric a little bit just to protect the Aussie dollar, because it's quite clear that the Aussie dollar is really inflationary.
Yeah.
Okay. How do I know it's inflationary? This month, the month of January, my Microsoft subscription comes due. Last year it was $139 Australian. It's now $180. That's 38% inflation. Also coming due is my NordVPN, which of course I need to circumvent potential new regulations post-election. My NordVPN has gone up from $146 to $249. That's about 50%.
Yeah. And
Okay.
it's not because the companies are raising prices
And it's
that
not.
much.
It's
'cause
part of
Aussie
it's
dollar.
the company raising prices. I accept that. Nord's not an oligopoly, but Microsoft is. Okay, but the Aussie dollar has had something to play on that.
Yeah.
Okay, and so what you're finding is the Aussie dollar's having an impact already. And don't forget, it's only against the US. It's been down against Europe, but not really radically weak. Okay, and the final thing about inflation, energy costs. One of the most structural problems we have in Australia is energy costs. They're being subsidised at the moment, and that subsidy will fall off. It'll come back on again. That will kill people. You know the rubbish that the current government talk about inflation rates being 2 and a bit. They're only 2 and a bit. They're really 3.5 because of the electricity subsidies.
Yeah.
Okay, and so that's going to change. So I think when all that feeds through, I think bond rates will be categorically 3-5%, and that's not fun.
No.
Nice.
Number 10. Lock your mum and dad up on this one.
Okay.
Put the earmuffs on. Don't let them hear this one. I think Australian bank shares will fall at least 15% at some stage this year.
Wow.
Okay.
This is, together with maybe the Magnificent Seven, where 3 had earnings downgrades over the course of last year, which were Meta, Apple and Microsoft. In the case of Australian banks, this is the real unravelling of stupid. So last year, ANZ returned 21%, Westpac 44, NAB 25, CBA 39. That's the 12 months to yesterday. Their profits before doubtful debts and tax, Westpac minus 4%, NAB minus 6, ANZ minus 6.5. That's why the MD's leaving. And Commonwealth Bank, don't forget, they're 3 months different balance at 2 and a bit. That would be worse if you move them forward 3 months, okay? Their returns on equity are all 10 to 11% except CommBank, which is 14. Compare that to JP Morgan, which is 17, and Goldman Sachs, which is close on 16. These companies trade on 16 plus times earnings, apart from the Commonwealth Bank, which is now nicely in the 20s. Their bad debt provisions are minuscule. Last year, they averaged about 16 basis points of risk-weighted assets. So what we have is profit before doubtful debt charges going backwards, and we have doubtful debt charges at ludicrously low levels, given what we've just been talking about in relation to the economy, and these things making 20+% returns last year in the wake of earnings downgrades. Okay, their earnings were downgraded over the course of last year because of margin pressure by and large. So I think it's absolutely ludicrous where they are. Many of you may not know, one of my starting out positions when I came to Australia was actually a banking analyst in stockbroking for 2 quite large brokers. I was quite a well-known banking analyst earlier in my career, so I kind of understand banks pretty well. I've never seen Australian banks this stupid in my life. And I've not seen them doing stupid things like they're doing in my life as well. Buybacks, increased dividends. Makes no sense.
I reckon you've certainly seen increased dividends from the banks, but probably not when their earnings are falling.
Yeah, but it's nuts.
So here's the counterpoint to all of that, because that was all true last year, and what we saw was fund managers getting out of the banks. But that selling pressure was taken up by the super funds. And Macquarie had some data that in the last 12 months, the big super funds holding of the big 4 banks went from like mid-20s to in the 30s. And, the super funds are told they need to hug the index now. They're looking to buy quality companies at the top of the index. And they just seem to be buying the banks.
Well, on a 5 and a bit % bond yield.
Well, so that's where you reckon they'll go instead? Yeah,
absolutely.
Okay.
That starts to become a lot more interesting. And the banks, don't forget, I'm going to suggest to you that bank bad debt charges will increase. And if there's one thing gets bank PEs right up through the roof, it's bad debt charges increasing. The other thing, I just want to stress this because it's part of the whole debate about house prices, and everybody's talking about supply and demand. All right, that's logical. However, what's the biggest thing that drives house prices? It's credit availability. Always has been, always will be. To give you an idea, last year, Westpac raised 80 billion of debt. NAB raised 43, ANZ raised 51, and CommBank raised 52. Okay, they're much bigger, but they have a better deposit base, as you all know. These guys need to keep raising sort of $50 billion a year in debt to replace the stuff that falls off and to grow their book. What happens if the world says, No, not at that price you don't, when our collateral is massively overpriced Australian residential property. This is what happened, of course, in 2008. And the government brought in various measures to get the banks through what was, clearly a temporary period. To put it in context, those kind of numbers equate, depending on which bank it is, to somewhere around 14 at the high end down to about 8% of their housing loan books. Housing loan books are $416 billion for NAB, $484 billion for ANZ, $562 billion for Westpac, and $664 billion for CommBank. Most of these guys are, funnily enough, they all have roughly the same levels of debt. $144 billion for Com, $156 for both ANZ and NAB, and $169 for the slightly more levered Westpac. That is what will bring house prices down if these guys have to pay a lot more money to get access to global debt markets.
Okay.
Interesting.
So do you have a house price prediction on the back of that?
No.
Nice. that's
I just think they're ludicrous. But don't forget, Melbourne's not Sydney. And Sydney's not the world's greatest house price market. Adelaide, Well, sorry, actually wrong. The Sunshine Coast, yes.
Oh yeah, Perth did pretty well last year.
Perth did well. So no, I don't have a prediction for house prices, but I don't own a house, so I think it's fairly obvious what I'm thinking.
But you think Aussie bank shares will fall at least 15%?
I think Aussie bank shares at one stage will be down at least 15% from where they are now.
So that's 10 down, 4 to go.
Yeah.
What's number 11?
Number 11, let's go a bit global again. And since you don't have any money left because you've paid for the Qantas flight in a 22-year-old plane back from America, then you're not going to have the money to buy luxury. And so my prediction is that there'll be no rebound in luxury shares.
Oh, wow. Okay.
Now, one of the things that we talked about here is perhaps a reversal of trends that were in place in 2024. I put some thought into this. Not every trend is going to reverse. Okay, you can't just say, that went down in 2024, it's going to go up in 25 or vice versa. I think luxury shares are still too expensive. There's still too much inventory. There's increasing legislation to stop them disposing of inventory. You might remember the French are going to stop Hermes burning handbags, which is the way they keep the inventory down.
I didn't know that.
Yeah, absolutely.
Wow.
This is going to run slightly counter, you may think, to prediction 14, but the Chinese consumer is not so hot, okay? But there'll be stimulus as the year goes on, but I don't think the Chinese consumer is sort of hot. Now, what does that mean? It means that certain luxury stocks may do very well because it's high end, and that's what you saw early in the year with the results from Richemont. Richemont, covers a whole gamut of things, but its highest end brand is Cartier. Oh, sorry, they're not called brands, they're called Maison. So it's Cartier, whereas some of the other things didn't do quite so well. So the very, very top end may do well, but most of these things basically sit in the medium end of aspirational. So Kering, which owns Gucci, Saint Laurent, things like that. LVMH has 75 of them. They're not all top end, that's for sure. And I think things like, Moncler, Burberry and stuff like that, they're going to continue to struggle.
Okay.
So beware, because there's a lot of value managers are telling you luxury is going to rebound.
Yeah, you look at Kering, it's down like 75%.
Absolutely.
Trading on like 14 PE.
Yeah. So some of the PEs are not that cheap still.
Yeah.
On a very similar theme. Prediction number 12. The value manager nightmare of 2024 was alcohol.
Okay.
Booze. Most booze stocks were down, and some were down horrifically. And I'm predicting that there'll still be no rebound in booze stocks. What do I mean by booze stocks? I mean things like Diageo, Brown-Forman, Remy Cointreau, Pernod Ricard, Heineken, AB InBev. The last two are beer stocks. They're a little bit cheaper than the others. And I think beer is a little bit more ubiquitous, so I don't think they'll do as badly. But the others still trade on somewhere between 17 to 20 plus times earnings. Their organic revenue growth is negative. Their revenue growth comes from acquisition. Some of these stocks are down. To give you an idea, Remy Cointreau is down 72% in the last 3 years. Diageo was the subject of quite an interesting note by a gentleman called Terry Smith. Terry runs Fundsmith in the UK. He's one of the most famous UK investors. He's a very famous man. Google him. He got sacked from his job at UBS for writing a book called Accounting for Growth, which exposed the accounting shenanigans of, unfortunately, some of UBS's clients. So they said, pull the book or get fired. So he got fired.
Wow.
Okay? So he's been an excellent fund manager, and Fundsmith is a sort of high quality, invests in high quality companies. So he actually sold his Diageo. That's Johnny Walker and Guinness to point them out. So I don't think there's going to be a rebound in these stocks because Gen Z just don't drink as much. It's a structural fact now. That may change in due course, but at the moment they don't drink. Okay, they may use other things to get their stimulus, and I'm perfectly serious. Whether they should is a different matter. But they're using different things, and there are so many value investors stuck in that area. In addition to that, there's structural oversupply of booze. Look at whiskey inventories around the world. And also what you've got is that brands are not as meaningful as they used to be. One of the biggest things to learn out of all this and out of this prediction is brands are so much more ephemeral in many places than they used to be. If a major sports star comes out with a new vodka, it gets real traction because, of course, that star's doing the advertising and the marketing for nothing because they own the brand or part of the brand. And, that gets traction because of social media and everything else. Some of the old style brands, sure, they're still hefty, they're still high. Japanese whiskey can charge what it wants, because it's a different marketplace. But some of the other things, no. So don't be sucked in yet.
Okay,
Nice.
Yet. 13. If there's an existential threat to booze stocks and a little bit of a threat to luxury, it is nothing like the existential threat to motor vehicle manufacturers.
Yeah, right. Okay. Yeah.
Okay. You have just this enormous structural change wafting through that market. Most obviously EVs, most obviously Chinese EVs. So we now have excess supply across the core part of the market at ever lower prices that conventional manufacturers can't compete with. If Nissan and Honda are looking to merge, holy moly, what's going to go on in Europe? What's going to go on? What's maybe even going to go on in the US, even though some of those guys are a little better positioned on EVs?
Well, it's already happening in Europe, isn't it? Volkswagen shutting down its first plant.
Yeah. That is enormous. Now, some of these companies have quite a lot of cash, but that erodes really quickly. And don't forget, a lot of them have got a finance subsidiary, which is really where the debt is. That's the leasing components of their business. So just beware if you analyse these things. Don't forget, GM's getting out of the robo-taxi market, which was a very logical extension to, what they were doing in EVs. So, to me, I just think if you're looking at investing in motor vehicle companies, no matter where they are, whether you're looking at a Ford or a GM, or you're looking at, a Stellantis or a VW, or you're looking at, Honda, Mazda, whatever. Just be super careful this year. I think, they had great years in 2023, some of these companies, and into 2024. Stellantis had an enormous year and then fell in a hole inside 4 months. Okay. So you just got to be really, really careful. And if you're going to be in this business, well, guess what? You've got to be in ultra luxury, and, that's not that cheap either, right?
Yeah. Now, the one car maker that most people listening, if they own a car maker, would own is one you haven't mentioned. Where does Tesla fit in it?
The pricing of Tesla is just now completely insane because if it's never been a cult company, which it has, it's now a super cult company because of the proximity of its managing director to President 47. The pricing of it's crazy. It'll earn about $3.20 a share, and you're looking at a share price in the 400s.
Yeah.
Yeah, it's got other things I acknowledge, but they're not enough to at this juncture.
Exactly, they're not real now.
They're not, to override, the vehicle business. So I couldn't possibly own it. I have shorted it in the past. I won't short it at the moment because it's trading on cult numbers. It would be dangerous in the extreme.
All right.
Okay.
Final one.
Okay. After 3 lots of
Downgrades,
mundanity, stay out of. I like to finish on a positive note.
That.
Okay.
I like to finish on a positive note. No. I am going long China technology and internet.
Okay.
Okay, the easiest way to do it is Crane Shares Internet, like ETF, which is KWeb.
You've spoken about that before.
I've spoken about that before, and it was really good. Why do I think this is really good? Number one, the person who loves President 47 even more than the chief executive of Tesla is President Xi Jinping, because he knows he has his measure any day of the week. He loves President 47. Secondly, there is stimulus in China. It is stabilising the Chinese economy to a degree. And the kind of things that are in KWeb are basically the internet sales companies, the Tencents, the Pinduoduos, these kind of things, who basically revel in selling low-priced goods to people who don't want to pay a lot of money for these kind of things. Plus, obviously, the net, and communication across the net as well. What's interesting as well, and I think will emerge over the course of this year, because it's going to be a political issue, is that China has probably done rather more at replacing US-based chips and things that make stuff work in China than probably President 47 realises. And I don't think China, from a tech point of view, are anywhere near as badly off as some of the naysayers in America would have you believe. And I think, you're starting to see that with, some of the Huawei chips that are coming out. You're starting to see these massive consumer platforms spread across the world. And if the world's going to be a bit of a slower place, perhaps, nobody thinks it is, but if it's going to be a bit of a slower place and you want cheap this and cheap that, where do you go to get it? You go to these guys to get it. And I think with China rebounding a little bit, a number of these companies, they're on effective PEs of 8 and 9.
Yeah.
Okay.
Now the counterpoint, just for people for completeness, Huawei last year completed 7 nanometer chips, which surprised everyone because they didn't have lithography machines from ASML.
Yeah.
But this year, TSMC are going to do 2 nanometer chips, which would put them 3 generations ahead of the Chinese Huawei. So that is the counterpoint to what
there are some counterpoints, and don't forget that there's another counterpoint is that chips seem to sort of kind of leak through the barriers, shall we put it?
Well, that did happen last year, didn't it? Yeah, they discovered a lot of US chips.
Absolutely. So I tend to think that China's been written off as uninvestable and everything else. Please, we know why, okay? Because don't forget, in many cases, you're not buying shares in the underlying company. It's not like buying shares in, Apple. You have common stock that you can vote at a meeting. Many of these things are shares in some kind of underlying kind of funny little vehicle. So just, please bear that in mind. I understand the cries about uninvestable, but these companies are now very, very cheap indeed. Don't forget, within China, there's massive competition. Okay. PDD's been hammering everybody else. PDD own Temu. Yeah. Okay. So, they've been nutting everybody else. So there is competition within it, which is why don't bet on one, bet on a range of them. Return, which are the delivery guys, Tencent, Alibaba, all about.
Yeah, Baidu, all of them.
Yeah, that's one of my long thoughts. So if you
Love
think I've been dull and really downbeat, I have suggested longs in that, and also I have told you I'm long Novo Nordisk.
Yeah, never dull,
nice.
Andrew. I don't think anyone would ever accuse you of being dull.
Okay. And no mentions this year of oil or gold. So there you go.
True. Yeah.
There we are.
Well, thank you as always.
Yeah.
Looking forward to seeing how it pans out.
Yeah, I think, if we're talking China to finish, the Chinese proverb really is apt to this year. May you live in interesting times.
True.
They're going to be remarkably interesting. Just curb your trading a bit. There'll be opportunities, but just be really careful. It's
Yeah,
not going to be
nice.
easy.
Now, Andrew, if anyone listening wants to actually keep up to date with how you're thinking, stocks you're investing in, et cetera, throughout the year, what's the best place for them to do that?
The best place for them to do that, they can go to our website, which is east72.com.au. The lengthy pieces on that website are under Dynasty Trust.
Yeah.
And if you click down that, every quarterly report is on there. I do usually push them across socials. And there's also a monthly report, which is only one page, but it does show you the 10 stocks that are the highest weighting in our Dynasty Trust. And it gives just a few paragraphs commentary on what we did. But the quarterly reports are, usually somewhere in the order of 20 to 35 pages.
Yeah, always
cover usually one or two major stocks and everything else.
Yeah, in serious depth.
In a fair amount of depth. So there you go.
Love it. Well, for the sixth time for Bold Predictions. Thanks for coming on. Always appreciated. And we'll touch base at the end of the year.
Absolutely. The biggest question, of course, will there be a seventh?
Yes.
Yeah.
Will I bomb out like last year?
Or will Equity be around?
And you'll get Jeff Wilson to come on instead.
No.
No, I'm pretty confident there will be. But Andrew, we
So
always
am I.
appreciate it and we love having you on. So thank you.
Thanks, guys. Enjoy.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.